No matter your age, your plan for retirement can start today. From the News Channel 5 network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about a number of things today. Of course, one of the things that I know is on a lot of people's mind is that of what's going on with the markets and the volatility we're having in the markets this year. Something to keep in mind when you think in terms of bull markets, bear markets, and of course we're in a bear market right now. In fact, I think on the S&P 500, it's down about 20%, a little over 20% year to date. NASDAQ is the one that, by the way, is really down. It's down about 31.8% year to date. Today, with the inflation numbers that came out, didn't see anything there that was going to help the market. So likely we're going to see the markets, I would expect, on a Friday, all things considered, very likely a negative day. Of course, the market can surprise you, right? And that's one of the reasons that we would all be very wealthy if we knew what the market was going to do on a given day, or for that matter, a given week, month, year. We don't. But some things to think of are how to prepare. Like, we're in a bear market, what do you do? One of the things is just check your allocations. This is a good time to reassess, if you will, what your portfolio looks like, what type of holdings you have, making sure that the things that you have are, in fact, that you're well positioned. If you've got a well-diversified portfolio with thousands of different holdings, thousands of different companies in it, you're likely going to be able to weather this bear market quite well. One of the things we're looking right now is, are we going to see that bottom this year? Is it going to carry on into the first or even second quarter of next year? These are a lot of things that analysts are talking about, and of course everybody's trying to read the tea leaves and figure that out. What you need to be thinking of, since we don't know, what we do know basically is when it hits that bottom in the last two, not counting the little flash bear, but in 2000 through 2002, it took about 7 years to recover. In other words, from the beginning of the bear market, right, to the peak just before that bear, to the time you were back to that break even of what it was before that bear market, took about 7 years. And then in 08, the financial crisis, basically from March of 07 through, from October of 07 through March of 09, the market dropped about 55% and took about 5 years to recover from that. And then, of course, we went on the longest bull market in history after that. Now, what does the future hold? No one really knows. I mean, if you ask even one of the most famous investors of all time, Warren Buffett, when asked in interviews what the market's going to do, he always says pretty much the same thing, which is he does not know. What he does know is that over time it goes up. What it's going to do in the short term, who knows? And this is the thing. There are so many different variables, and there's some things we're going to be watching. Today was one of them with the inflation numbers. We'll be watching that again next month. The Federal Reserve is going to be meeting next week. They've already pretty much put out there that they're going to be doing about a 75 basis points increase in interest rates, and that's going to have some pros and cons to it in terms of how you look at not only your portfolio, but your overall plan. One example being that we're seeing fixed annuity rates go up quite a bit, actually. In fact, a 2-year, I think, around 3%, 3-year around 4%, and a 5-year up around 5.2, I thought just recently. And we're likely to see those continue to go up. In fact, it's possible with the 2 rate increases projected right now, the Federal Reserve is talking about next week, as I said, about 75 basis points increase. We will see if the inflation numbers that came out today, if that's going to impact their decision, if they're going to hold to the 75, if they're going to want to get more aggressive at 100. Not likely, but it could happen, and that would really, I think, bode negatively on the markets. Now, sometimes the markets will surprise us, and they might look at a hawkish move like that and say, now we're really getting serious about inflation, and it might be somewhat positive. again, trying to read the tea leaves like everyone else. So what I would be thinking in terms of, if I'm as an investor, is I want to be thinking, how can I make sure to protect myself, whatever the market's going to do? And one way to do that, again, be well diversified, good chance, again, a good time rather, to look at your asset allocation model, see what you're holding, make sure in terms of the risk in that you've addressed that, and you're managing your risk in your portfolio. Some things that you can look at too. This goes with bonds and that. And I'm going to have some help with this today. In fact, let me go ahead and bring Jeremy in. Jeremy Threlkeld with Virtue Capital Management is joining me here today in studio. And Jeremy, in talking about the markets, this is one that our clients, of course, are always asking us, what do we think is going to happen? It's very difficult. The inflation numbers that came out today, basically unchanged. So that some might look at that in a positive way, saying, oh, well, unchanged, at least they're not going up anymore. Maybe that means we're making some headway here. The others might say, this is that glass half full, half empty thing, I guess. Others might say, oh boy, it's still bad because they haven't come down yet. All of that is just one factor. We got elections coming up. We got a number of catalysts that could impact the markets here over the next couple of months. What's your take in terms of what you see?
Yeah, I think the biggest thing that's looming over the market is inflation. When the Fed increases rates, it takes a couple months for it to run through the economic cycle. So I think the Fed's been a little aggressive raising rates. I believe it's going to be some time before we really start to see those core CPI inflation numbers come down. And until the Fed really starts to see those inflation numbers come down quickly, they're going to continue raising rates. It's going to affect the market. But Hank, there's actually a high degree that we're probably going to tip into a short-term recession next year. Mm-hmm. So I think we're far from out of the woods, even though we've had a decent couple weeks with the market. But I still expect some volatility and market declines come in.
Well, we had the two negative quarters, which usually is indicative of a recession, of course, but then the third quarter actually came in showing some growth. So it is difficult to see which way that's going to go in terms of going into next year. There's a lot of people that agree with you as far as a recession, going into a recession, or getting into a deeper recession. All of that being said, though, how do the markets historically are going to react to that? The markets typically are going to lead us out of recession, so we're going to see maybe the markets start to go up before the economic news shows more positive signs.
Yeah, the market usually precedes a recession in terms of recovery. Now the hardest part is picking the bottom when that's going to happen. So I think the economy will start to show some signs of improvement, and then we will see the market start to recover, probably, possibly a quarter before we really start to see some good economic improvement. Now when that is, that's a little tougher to say, but I'm projecting maybe 6 months into next year, we're really going to start to see things cool down, hopefully.
Yeah, and depending on how you're invested, this is another key part. Let's say whenever that bottom occurs, how long is it going to take to recover? I mentioned that in the last two bear markets, that was 5 and 7 years. That doesn't mean that your portfolio is going to necessarily take that long. If you're in a typical 60-40 type portfolio, you should have a lot less risk than the market. So you shouldn't, when we're talking about the market being down 20%, you might be down more in the 12 to 15% range. So then, same thing coming back out of that bear market when we start seeing the markets increase. And usually, by the way, out of a bear market, the following year, let's say. So let's say that we bottom out this year, and it maybe starts out a little, maybe even if the market's down at the first quarter or so of next year, it may, just like in 09, as I mentioned, the first 3 months of the year, the first quarter, the market was still going down, but then it hit its bottom in March, turned, and then we ended up with in 09 with a I think it was 27% increase in the S&P. So that's the other part. You don't want to miss out, and this is the part where it gets into trying to time the markets can be very dangerous. And this is one of those, Jeremy, where unfortunately, and I know you're like to follow Dalbar as well, an independent research group there for that tracks individual investors and their results, if you will, in the market, how they do relative to the market. And normally Dalbar is showing investors getting only maybe a third to a half of what just having an S&P 500 index fund would give them. And one reason for that is market timing.
Right, right. Now, a lot of what plays into that is investor emotion. Being emotional about investing, seeing the market when it's down, saying, oh no, I've got to sell and get out, I can't have any more losses. When the market recovers, the investors have a fear of missing out syndrome where they invest usually towards the top. So they're selling at the bottom and getting in at the top, and that really erodes returns. So you're correct, Hank. That Dalbar study shows your individual do-it-yourself investor has an average annualized return of only 3 to 4%. And that's primarily due to making bad decisions.
Yeah, and we let emotions sometimes control what our decisions are. When we get scared, when the market's going through turmoil like it is, and that tends to, we might think, oh, I got to get out of the market, or it's too scary right now, and I'm going to sit on the sideline. And then you're waiting maybe for that entry point to get back in, and you miss out on some key days, and it can make a huge difference. If you miss, there's a study showing just with missing the top 10 days out of 10 years in the market, just the top 10 days would cut your returns almost in half. The market timing, again, is a really difficult and usually unfruitful type of strategy to try to pursue. So it's more about staying invested. Now, saying that doesn't mean that there aren't some tools that can be used to help you mitigate and manage your risk in the market. And it's not just, it starts, of course, with asset allocation, how you put together the different pieces in your portfolio as an example. I've talked about modern portfolio theory, mentioned it in my book, or a chapter of it in my book, How the Smart Money Invests. And one of the things that we get into with modern portfolio theory is talking about asset allocation being the biggest determinant of what kind of return you're going to get over time, and of course what kind of risk or volatility you're going to have as well. Now, having said that, there's some other strategies though that maybe can help you manage that risk and improve your returns. And Jeremy, maybe you'd like to share, we've talked about stop loss. That's one of the ones that is a good strategy for that. Maybe you can tell a little bit about the stop loss strategy. One main thing about that, with what we're talking about, how it relates to the emotional decisions sometimes that people make and how this can help protect them from that.
Yeah, absolutely. Our stop loss strategy does a great job of taking the emotional decisions out of when to sell out of the market or get back in. But the stop loss in its most simple form, it sells out of the market when we've had a 12% decline from wherever the S&P 500 peak. Now, it's not a market timing strategy, even though it does cut losses way before the S&P bottoms. The 12% declines based on 40 years of historical data, and the reason it's 12% is usually we see a market bounce back or a resistance level when the market declines 10%. But after the market declines 12%, historically the market's going to continue going lower. So getting out at that 12% mark, we have a high probability of mitigating further losses. Now, when to get back into the market, we use a technical retracement called a Fibonacci retracement when we see a 50% recovery from the bottom. So we know it's really safe and a good move to get back in the market because we've established a trend line of good market growth. Now, the other thing with the strategy, Hank, is the market declines more than 30%, even though we don't want to see that in the market, that's actually good for the stop loss, even though it's on the sidelines, because at that point, the stop loss is going to get back in much sooner than a 50% retracement. So you can see much more market participation and faster and quicker gains. So it does a great job of taking the emotional decisions, moving you to the sideline. That way, as an individual investor, you don't have to wait up at night thinking, oh, when do I sell? Should I sell? Is it a bad time? You know, what if I sell at the wrong time? This does it for you.
That's it. And it's again, nothing works 100% of the time. So research shows that the analysts that have been involved in this, both Virtue Capital Management and TKA, Phil Kosmala with Tabor Kosmala up in Chicago, a lot of the work that's been done, a lot of the research is showing that statistically, that when, as Jeremy was saying, when you hit that negative 12, statistically, it usually is going to keep going down, okay, most of the time. Now, there are going to be exceptions. This year happens to be one of those exceptions where we've seen 3 triggers, which is very unusual. In fact, there was a write-up, and I'll have to look back on the article, whether it was Market Watch or Wall Street, but in the article, it talks about 3 triggers. Oh, forgot. You know what? I'm going to take a break. I'm running here a little long. When we come back, I'm going to get back into that. We'll talk about that more today about the markets. Join us here. We'll be right back on the Retirement Report.